You know, when you see a velvet rope outside a building, your brain just, well, it immediately makes a calculation. You assume whatever is behind that rope is expensive, exclusive, and probably not for you.
Right. Yeah.
It's totally binary. Like you were either on the VIP list or you were standing on the sidewalk just looking in.
Yeah, but what if a company figured out a way to put a velvet rope in front of literally everyone, let them all inside, and somehow kept that VIP feeling completely intact?
I mean, that would be the dream, right? And apparently it's a reality because Aritzia's net income just jumped an unbelievable 176.6% to $117.3 million.
It's wild.
And that is just in one single quarter. So we are looking at their Q1 2027 investor presentation and their first quarter fiscal 2027 financial results, which, by the way, just dropped today, July 9, 2026.
Hot off the presses.
Exactly. And the mission for our deep dive today is to really deconstruct how they achieved this massive 43% revenue spike, dissect their playbook, and figure out what lessons you can apply to understanding consumer behavior right now. So, okay, let's unpack this.
Let's do it.
Because seeing a 177% jump in net income in just a 3-month period, I mean, that means we are looking at a business model operating with some kind of, I don't know, supernatural leverage.
Yeah, it really does seem that way. But to understand the math, we actually have to understand the psychology of what they are actually selling.
Okay, great.
Because if we just look at the raw numbers, we miss the whole engine driving the machine. I mean, this company started in Vancouver back in 1984, but they don't even call themselves a retailer.
Wait, really? What do they call themselves?
They describe themselves as a design house with an innovative global platform.
Oh, fancy.
Right. And the core of that platform is a concept they've actually, they've trademarked it. They call it everyday luxury.
Everyday luxury. Okay, I'm actually looking at the visual chart from their investor presentation right now, where they map out the entire global fashion landscape.
Yeah, that chart is super helpful.
It really is. So at the very top, you have luxury and sub-luxury. This is, your high-end designer labels, the $1,000 t-shirts, the bags that cost as much as a used car.
Exactly.
Then, way down at the bottom, you have the mass market. That's your mid-market, your fast fashion, your discount stores. And Aritzia strategically drops a pin right in the massive empty space between those two extremes.
Yep.
They are deliberately claiming that middle ground.
They are, and they base this positioning on 4 very specific pillars. So the first is what they call beautiful product, which, translates to utilizing high-quality fabrics and obsessing over superior fit.
Right.
The second is aspirational environments.
As the stores.
Exactly. The physical boutiques themselves, which are specifically designed to feel incredibly high-end. Then the third is engaging service, and the fourth is captivating communications.
Okay.
And they've proven this isn't just a women's wear phenomenon either. They brought this exact same philosophy into menswear back in 2021 when they acquired Reigning Champ.
Oh, right. The premium athletic wear designer.
Yeah, exactly.
It makes me think of flying premium economy.
Oh, that's a good way to look at it.
Yeah, like you are not paying for a private jet, but you are definitely not crammed in the back row next to the bathroom either.
Yeah.
You get the warm towel and the legroom without, staring down a massive credit card bill.
Right, totally.
But I actually have a hard time wrapping my head around the terminology here because doesn't the word luxury inherently imply exclusivity?
Well,
Like if something is every day, doesn't it kind of lose its magic? If everyone gets the warm towel, it's just not special anymore.
I mean, that is definitely the traditional way of looking at it, for sure. But modern retail psychology has really shifted.
How so?
What is so fascinating here is that retail today isn't strictly about true scarcity anymore. It is about the feeling of exclusivity.
The feeling, okay.
Yeah, Aritzia is providing the aesthetic and the emotional payoff of a high-end experience without that insurmountable price tag.
Yeah.
Just think about what happens when you actually walk into one of their boutiques.
Right, yeah.
You are surrounded by marble counters. The lighting is, it's custom, it's warm, it's flattering. The layout feels curated, not like some big warehouse.
Mm-hmm.
And most importantly, you receive personalized concierge-level service from the staff.
So they are essentially democratizing the VIP experience.
They are making it attainable. And when you give someone who is, say, used to fast fashion a taste of that high-end treatment, it creates an incredibly powerful emotional bond.
Oh, we bet.
They aren't just buying a sweater, they are buying into an identity.
I get the vibe. I mean, they have clearly mastered the aesthetic. But, a good vibe doesn't automatically print money.
No, it does not.
So I really want to look at whether this everyday luxury concept actually translates into a sustainable business model. And looking at the Q1 2027 numbers, they definitely suggest it does, but the scale of it is what I just find shocking.
It's massive.
Total net revenue hit $951 million.
Yeah.
That is a 43.4% increase from Q1 of just last year.
Right, and the top line revenue is the first indicator that this strategy is resonating. But the more telling number, honestly, is their comparable sales.
Okay, break that down for us.
So, for anyone following retail metrics, comparable sales measure the revenue generated by stores and digital channels that have been open for at least a year.
Right, so it filters out the noise.
Exactly. It filters out the revenue from brand new stores, giving you a true picture of the underlying demand. And Aritzia's comparable sales grew by a massive 35.1%.
Wow. I mean, in an industry where mature retailers pop champagne for like a 3 or 4% increase, hitting 35.1% is almost absurd. It means their existing footprint is seeing an absolute surge in foot traffic and online orders.
Absolutely.
But I am looking at an even deeper metric here, and I really need you to explain this because it kind of defies logic to me.
Okay, what is it?
They are making more revenue, yes. But Aritzia is actually making more money on the individual items they sell.
Ah, yes.
Like their gross profit margin expanded by 3.1% to reach 50.3%.
Yep.
And their operating profit, which they call adjusted EBITDA in the report, hit $191.6 million. That's an 80.5% increase. I mean, apparel is notoriously low margin, high overhead.
Very true.
So how on earth are they breaking a 50% gross margin while scaling this fast?
Yeah, so crossing that 50% threshold in apparel is a massive operational milestone. It rarely ever happens by accident.
Clearly.
The how behind this comes down to 3 operational efficiencies that they detailed in their financial results. So first, they highlight what they call IMU improvements, which stands for initial markup.
Okay, but what does that actually mean on the factory floor? Like practically speaking.
Well, practically, it means they're sourcing and producing their garments way more efficiently. When you scale up the way Aritzia has, you aren't ordering 1,000 units of a particular fabric anymore.
Right.
You are ordering tens of thousands. And that scale gives you immense negotiating power with your suppliers.
Volume discounts.
Exactly. You drive down the cost of raw materials and manufacturing, so the gap between what it costs them to make a piece and what they initially sell it for naturally widens.
So they're essentially padding their profit margins before the garment even leaves the factory.
Precisely. Now, the second factor is leverage on store occupancy costs.
Okay.
Think about a physical store. The rent, the electricity, the basic staffing, those are all fixed costs, right?
Yeah. The landlord doesn't care if you had a slow month.
Exactly. If a store does $1 million in sales or $2 million in sales, the rent stays the same. Because Aritzia pushed 35% more volume through their existing stores, those fixed costs suddenly represent a much smaller percentage of their overall revenue.
Oh, I see. Which leaves way more profit at the bottom line.
You got it.
Okay, and what was the third factor?
Fewer markdowns.
Oh, well.
Yeah, this is the holy grail of fashion retail. When consumer demand is this robust, you just don't need to slap a 40% off sticker on a rack of coats to get them out the door.
People are just buying them anyway.
Exactly. People are paying full, undiscounted price for the product.
That is just, I am really impressed by the margins, particularly because they pulled this off while facing some severe macroeconomic headwinds.
Yeah, they really did.
I mean, the report specifically flags new tariffs and the elimination of the de minimis exemption. And just for context for you listening, the de minimis rule generally allows lower value shipments to enter a country duty-free.
Right.
So losing that exemption combined with new tariffs adds direct, unavoidable costs to importing goods.
And the fact that Aritzia absorbed those new taxes and still expanded their gross margin by over 3% tells you literally everything you need to know about their pricing power.
Seriously.
They didn't eat the cost, and it didn't hurt their margins. They optimized their supply chain to offset it entirely.
It's incredible. We are talking about nearly $1 billion in a single quarter. I have to ask, where's this tidal wave of cash actually coming from?
Yeah, that's a good question.
Because they started in Vancouver, and the Canadian market is still growing. Like, it was up 25% to roughly $313 million. But that still doesn't account for a 43% overall spike.
No, it doesn't. The real story here, the massive growth lever they have pulled with, like, surgical precision, is their geographic expansion into the United States.
Oh, the American invasion.
Exactly.
The American market is now officially their biggest driver. I mean, it brought in $638.1 million this quarter.
Yeah.
That is a 54.5% increase from last year, meaning the U.S. now makes up over 67% of their total net revenue.
Which is huge.
And a huge chunk of this is tied to physical brick-and-mortar retail. Retail net revenue hit $666.3 million globally. They're sitting on 143 boutiques across North America. And in just the last 12 months, they opened 14 brand new boutiques and entirely repositioned 5 others.
And they are definitely not slowing down.
No, they are accelerating. They are planning capital expenditures for fiscal 2027 of around $250 million, and $210 million of that is earmarked almost entirely for these physical boutiques.
Yeah.
And I actually have to stop and push back here for a second because this feels like a massive misallocation of capital.
How so?
Well, we have been told for a decade that physical retail is dying. Right.
Right, the retail apocalypse.
Exactly. Malls are emptying out. Everyone is just shopping on their phones. So why is Aritzia pouring $250 million into physical real estate when digital is the obvious future?
It's a fair question, but it's because Aritzia fundamentally rejects the premise that physical retail is dying.
Really?
Yeah, they believe mediocre physical retail is dying.
Ah.
We have to look at how they actually view a storefront. They aren't just signing leases to hold inventory. They are building what we discussed earlier, aspirational environments in premier real estate locations.
Okay, but how does a marble countertop justify a $210 million investment? I just don't see the ROI there.
Because the store itself operates as a highly profitable marketing campaign.
Oh, interesting.
Think about it. When they drop a massive, beautifully designed boutique in a high-traffic, premium area like a flagship location in Manhattan or Los Angeles, it acts as a physical billboard.
Right.
It drives immediate local brand awareness. They don't have to spend a fortune on digital ads to acquire a customer in that zip code because the store does the heavy lifting for them.
So they're basically trading digital customer acquisition costs for commercial rent.
Yes, and it's a highly calculated real estate play. Look at their outlook for fiscal 2027. They plan to open 12 to 13 new boutiques, and 11 to 12 of them will be in the U.S.
Wow, so almost all of them.
Almost all of them. They know that once a customer walks in, physically touches the fabric, and experiences that concierge-level, everyday luxury service in person, the psychology just shifts.
Mm-hmm.
That customer's lifetime value skyrockets because they immediately transition into an omni-channel shopper.
Meaning what? They buy in store once, but then they go home and buy 5 more times online.
Exactly. The physical boutique builds the trust, and then the digital channel scales the frequency.
Okay, I see the logic now. The physical stores are basically the top of the funnel.
You got it.
But relying that heavily on expensive real estate is incredibly risky if you don't have the digital backend to actually capture those repeat purchases. So how are they monetizing that foot traffic after the customer walks out the door?
Well, that brings us to their e-commerce 2.0 strategy. And honestly, the numbers here are even more explosive than their physical retail.
Oh, really?
Yeah. Digital net revenue saw the highest growth rate across all their channels, up 55.5% to $284.7 million.
That's insane.
It is. Digital now makes up almost 30% of their total net revenue.
But there is a massive red flag buried in these digital numbers, and it's something that usually terrifies Wall Street.
The inventory.
Yes, the inventory. To fuel this digital growth, their inventory levels just skyrocketed to $547.8 million. That is a 33.8% increase in inventory from the previous year. And, I mean, holding over $500 million in fashion inventory sounds less like a calculated strategy and more like playing Russian roulette with seasonal trends.
That sounds terrifying.
Because in fashion, hoarding inventory is like hoarding milk. It has a strict expiration date.
Yep.
If the weather changes or the trend shifts, that milk goes sour quickly. You are stuck with warehouses full of clothes nobody wants, and then you have to deeply discount them to clear the space, which completely destroys all that beautiful profit margin we just spent 10 minutes talking about.
You are entirely right to highlight that as a risk. Seeing a 34% spike in inventory is normally a massive warning sign of unsold goods just piling up.
Right.
But this raises a really fascinating question about modern supply chain strategy. Why did they deliberately choose to hoard the milk?
Yeah, why take that gamble? Because it could have backfired terribly.
Because they had unprecedented data suggesting they would need every single drop of it. In the presentation, CEO Jennifer Wong explicitly addresses this. She states, and I quote, "Robust demand for our spring and summer product, supported by our healthy inventory position, fueled this phenomenal performance."
So wait, It wasn't an accident. They intentionally stacked the warehouses.
They absolutely did. And the mechanics of why this worked are crucial to understand.
Yeah.
Because nothing halts digital growth faster than a customer clicking on an ad for a trending item, opening the app, and finding out their size is out of stock.
Oh, I hate that.
Right. The customer gets frustrated, they leave, and you've just wasted the marketing dollars it took to get them there in the first place.
Yeah, that makes sense.
Aritzia knew they were launching a new mobile app. They knew their digital marketing was firing on all cylinders, so they deliberately front-loaded their inventory for the spring and summer lines.
They basically bet everything on their own brand momentum.
And they won the bet. Because consumer demand was so intense, having that massive stockpile allowed them to capture every possible sale without running dry.
Wow.
It is a high-wire act, absolutely. If the designs had missed the mark, it would have been a total financial disaster. But because the product resonated, that so-called healthy inventory position was the exact fuel they needed for a 55.5% digital revenue spike.
And they are literally pouring concrete to ensure they can keep doing this. I mean, the presentation outlines that they are building a second distribution center in the United States and constructing an entirely new one in British Columbia.
Yeah, you don't build duplicate massive distribution centers unless you have immense conviction in sustained long-term volume.
Right.
They are looking at the U.S. market penetration and realizing their current logistics network will just buckle under the future demand. So they are future-proofing the back end of the business to support this whole omni-channel machine.
Okay, so with a blowout Q1 on the books and a $500 million inventory gamble actually paying off, I am looking at what Aritzia expects for the rest of fiscal 2027.
Yeah, the outlook is strong.
It is, but we also need to talk about the potential risks lurking in the macroeconomic shadows because, obviously, no company operates in a vacuum.
No, they don't. But the immediate outlook from management is incredibly bullish. For Q2 of fiscal 2027, they are projecting net revenue between $1.100 billion and $1.125 billion.
Wow.
If they hit that, it represents 35 to 39% growth just in the next quarter alone.
And for the full fiscal 2027 year, they've actually raised their guidance. They now expect to pull in between $4.55 billion and $4.75 billion, which is 23 to 28% growth over fiscal 2026.
It's massive.
But, and I want to pivot here slightly, the investor presentation also lists several explicit risk factors. We touched on them briefly, but looking at the disclosures, they highlight geopolitical events, new duties and tariffs, trade restrictions, and global supply chain vulnerabilities.
Yeah.
And as an impartial observer just reading this report, it is completely clear that while Aritzia is executing flawlessly on the things they can control, they are still highly exposed to global trade policies.
Very true.
Things like the elimination of the de minimis exemption or sudden tariff hikes, those are external forces that can drastically change the cost structure of bringing goods into North America overnight. And to be clear, we're just looking at what the company itself is identifying as risks in their own financial disclosures.
Oh, absolutely. And you can see in the financial results that management isn't just, assuming the good times will roll without any friction. They are taking those macroeconomic threats very seriously. They are proactively trying to control what happens inside the house, implementing what they call a smart spending initiative.
Okay, but how's that actually work in practice? Like, what are they cutting?
It's about finding run rate savings across the entire business. So optimizing everything from corporate travel to software licenses to marketing efficiency.
Really scrubbing the budget.
Exactly. And the data shows it is already working. This initiative helped decrease their selling, general, and administrative expenses, which is just the overhead cost of running the company. It brought it down to 32% of net revenue this quarter. Oh, wow. So even as revenue is literally exploding, they are systematically shrinking the proportional cost of their overhead.
Exactly. They are bracing for macroeconomic uncertainty by becoming operationally leaner.
Smart.
They want to ensure that if tariffs do bite, or if consumer spending suddenly drops, they are still maximizing the profitability of every single dollar that comes through the door.
I am also looking at a move they made regarding their own stock, which I think speaks volumes about how management use these external risks versus their own internal potential.
The buybacks?
Yes. The report notes they repurchased 564,500 of their own shares for $66.2 million under their normal course issuer bid.
Yeah, that is a massive stock buyback program. When a company uses $66 million in cash to buy back its own stock, it is sending a very clear, very loud signal to the market.
Right.
Management is essentially saying, even with the geopolitical risks, even with the supply chain vulnerabilities, we believe our stock is currently undervalued.
They are betting on themselves.
They are entirely betting on themselves. It is honestly a masterclass in modern retail strategy. When you take a step back and look at the entire playbook, Aritzia has fundamentally proven that physical retail and digital growth are not competing forces at all.
No, not at all.
They are amplifiers. By treating their physical stores as high-end, immersive marketing channels, they drive incredible digital loyalty.
Yep.
They have proven that you can scale the feeling of a luxury VIP experience without having to sacrifice the massive profit margins of a scaled business.
They turned a Vancouver design house into an absolute retail juggernaut in the U.S., entirely by giving people that velvet rope experience without the velvet rope barrier.
That's brilliant.
They successfully bottled everyday luxury in the fashion space, and it really just makes you look differently at the mechanics of consumer psychology.
Which actually brings up a fascinating thought to end on. Aritzia figured out how to democratize the VIP feeling in apparel. But think about the other mundane, everyday industries you interact with, right?
Oh, yeah.
Your weekly groceries, your fitness routines, your tech subscriptions, your daily commute.
Exactly. Which of those industries is currently ripe for disruption by someone applying this exact same premium but accessible playbook?
That is the question.
Who is going to look at a stagnant industry and become the Aritzia of the grocery store or the Aritzia of consumer banking?
I mean, we started by talking about the psychology of that velvet rope and how powerful it is when a brand finally lifts it and just lets everyone inside. It really makes you wonder where else we are all just standing on the sidewalk waiting for a company to realize that the real money is in treating everyone like a VIP.
Totally.
Well, thank you so much for joining us on this deep dive into Aritzia's explosive quarter. We hope you're walking away with a fresh perspective on how modern retail actually works behind the scenes. Keep your eyes open for those everyday luxury moments out there, and we will catch you on the next one.